couple things. It'll be Chewy and Paul, and there'll be a third executive. I think some of you know him, but I don't know if everybody does. So his name is Howard Fu. He's the Senior Vice President of Finance. He's this very handsome, muscular gentleman right here next to Chewy. So Howard is a very senior leader at Procore. He's deeply immersed with our go-to-market leadership team as well. So he's very, come on, you guys can sit down. Come on. He's very intimate with our operations. Prior to Procore, Howard was part of the team at DocuSign that helped them scale and go public. Prior to that, he's at LinkedIn. And prior to that, Howard and I worked together at Salesforce way back in the Old Testament days. So, the format for Q&A, there's a couple mics here on the two aisles here. So for you guys in person, if you guys can walk up, grab a mic, ask questions, and then online we'll be taking questions as well. And so Vivian's going to be monitoring that portal, and she's actually going to kick us off right now with a couple for Paul that are coming in online.
All right, so why don't we start with one on margin trajectory. Is the trend line of the 350 basis points per year for operating margin a formal target going forward, and what's the expected time frame for that to play out? And if you can also kind of talk about how to think about free cash flow margin as well, that'd be great.
Yeah. So our formal guide that we issued in earnings here just recently is negative 11%. I think for those of you who are trying to think through the coming years and how to think about that, you should take that 350 basis points and assume that to be kind of the average trajectory of margin progression over the coming years. Now, we did say we're not telling you it's going to be consistently 350 basis points every quarter or every year, and that we do believe there will be years where that's greater and years where it might be lower. But in general, for modeling purposes, I think that's the best way to think about how to carry forward that number. And as I had mentioned in the presentation, on the free cash flow front, you should assume it to be essentially similar, if not actually slightly better, in terms of how that margin progression will follow.
Okay, let's do one more from Vivian, and then we'll go DJ here on the right. Yeah.
Great. This is a two-parter on the payments announcement. Can you talk more about the economics that we should expect to see from Procore Pay? How much of an uplift should we think about? And will Procore primarily benefit indirectly, so through increased engagement, or will we charge a transaction fee? And the second part is from an organizational perspective, with Procore Pay, materials financing, and potential further insurance products down the line, are we building out a separate financial organization to help manage these kinds of products?
Sure. Why don't I hit on the latter one first, and then I'll go back to the former. So in terms of the organization, we have and we've already built out that separation. Obviously, there is a different level of competency, a different level of background, context, and information that goes with thinking about financial products. How do you make sure you're really thoughtful to how you manage that? How do you ensure you're thoughtful in actually the relationships on your capital partners, in the world of insurance, all the folks in capacity? So this is something that we're mindful will take a little bit of a different muscle, and we're building out that team that is focused on this, that comes with a different level of expertise. If I go back to the payment question and how to think about the flow there, we have yet to disclose pricing. It is something that we're still working through. I think the narrative we've put out to customers is the same one I will share here, which is that there are some players out in the market, and we believe that we can not only deliver a much better experience, but we can do that from a competitive pricing standpoint as well. And so there will be more to come as we really launch that beta, get into those conversations with customers. But right now, I think the thing to remember is that what we announced, is not a transaction business. It is a workflow business really aimed at solving a problem for the general contractor who brings those stuff into that ecosystem. By entering that flow of funds, there's a lot of really interesting things that we believe we can do over the course of time, but that is not what we announced, and that is not something that we are at this point ready to really talk about on how it may actually impact the model. So when you all think about payments, think about it as a B2B SaaS offering.
All right, DJ.
Yeah, thanks. DJ Hans from Canaccord. So I'm actually going to ask a question that kind of bridges those two, which is margins and payments. As we think of kind of the ramping of the financials portfolio, I'm most curious in gross margin impacts and then incremental sales and marketing dollars kind of tied to these initiatives. I mean, it feels like it should be kind of a natural pull-through, but curious how you're thinking about it.
Yeah. From a sales and marketing perspective, it is very much, as you said, a natural pull-through. In many cases, as we think about the customers that are going to be buying this product, they are the same customers that already exist in our install base. These are folks who use financials, who use invoice management, and this is just that natural next extension of what they need to do to complete and finalize that workflow. So we actually feel from an efficiency standpoint on the sales and marketing front, this should be a positive contributor on that front. From a gross margin standpoint, I would tell you there's nothing unique to call out there. There are certainly some costs associated with how we process and transact that money flow, but in general, we feel good that the long-term target we put out there from a gross margin standpoint is still the right one to think about.
Yeah, don't make any changes to gross margin in your model. Yeah. All right, Ken.
Ken Wong from Oppenheimer. Just a question on international. One, you were talking about seeing some leverage as you scale international. I think on the last call you also talked about potentially needing to kind of reevaluate how you guys go to market international. How should we think about kind of that timeline to leverage and scale on the international side?
Well, I'll tell you about what we're doing, and Paul can talk about the impact of that. So we look at our international business much like we look at our newer businesses, which is we are learning as we go, right? And so we're taking the best practices from the last experiences and pulling them forward. And we are very interested in looking at what dynamics work best in which markets. And so we're basically lifting the hood on that kind of org design and operating model to make sure that we are going to be able to grow efficiently. What we know is, just like in the U.S. market, like we experienced 20 years ago, construction is slow to adopt technology, not because they don't love technology, it's because they, first of all, never had any technology at their fingertips, and secondly, the technology that was provided to them has been just junk and actually slows them down. So going into a new market where the brand awareness is very minimal takes time to build that brand awareness, get those reference customers, get our sales force up and running and productive. So that's where we're focusing most of our energy right now. But I'll tell you, any of the kind of the stumbles that we've seen have all been internal learnings and executions, and they've not been external macro for the most part. So we remain incredibly hopeful.
Let me jump in and talk about timing. Yeah. So when I think about the evolution of international, you saw from some of the content that Matt put up and Paul put up that we've accelerated the magnitude of our investments in recent years in international, and with that, with some of the growing pains. But I think what we started to learn is that we had a lot of breadth in terms of the markets that we were going into. And when you start off in some markets, I think Paul likes to use the term bear hug. When you start in some markets, you have an individual that can play an AE, an SDR, an office manager, a public relations person. As you start to get to scale, you do need some specialization in order to take advantage of the opportunities that are there. And I think we're hitting some of those points in the markets that we're in. And so what Tui's mentioning is, as we think about org structure and operating model and so forth, it's really about coordinating and getting the sequencing right and the timing right for the specific markets that we're in to be able to take advantage of those opportunities.
I don't think I have anything to add.
Well said, Howard.
Maybe a quick follow-up on international, and I'll throw it over to Brent over there. On the LTV to CAC metric, it looks like there's some headroom to get to 11 if you're trying to line it up with what you're seeing domestically. Is that more of a kind of a numerator problem, or not problem, a numerator dynamic or a denominator dynamic in terms of what closes the gap?
It's numerator. That's where you go back to the share of revenue versus the share of spend, the horizon of time it takes to stand up a leadership team, a brand, a pipeline, get those reference customers, and get those flywheels spinning. So that's where we continue to believe that the product market fit, the strategy, the regions, the need, like those things have not changed. And it's just a function of being in those markets for that horizon of time and executing on the org structures that we believe will scale with us.
Got it. Thanks, guys.
Mr. Braceman?
Hello, thank you so much for the additional disclosures today around the different segments. As analysts, we appreciate more, not less.
You're welcome.
But I wanted to drill into one area that felt a little different. It felt like it's getting a little more focused, and that's the specialty contractor area. This is an area that's only 14% of ARR. If I look at the total customer base, I think you have 13,000 paying customers. There's 60,000 on the Procore community network, so big gap there to monetize that space. At the session yesterday, workforce management booth was packed. The Procore Pay booth was packed. So walk us through, how do these things manifest? Is there an opportunity to accelerate some of the monetization things around specialty contractors with the now greater focus, and that looks like greater investment around sales capacity as well? So really a question around, can you monetize specialty contractor, and can you do that maybe a little bit faster in 23 and 24 than maybe we appreciate it?
Absolutely. It kind of goes back to the old mantra, which is the bigger the business is, the longer it's been in market. Specialty contractors is relatively new business for Procore, not super new, but our go-to-market strategy around specialty contractors was very much similar to our go-to-market with general contractors. And we believe that changing that dynamic through Procore Construction Network, through catching them at their time of need inside the application, is really going to be the area where we can get access to all the folks that have us and need us at that time of need. So the mantra is that you ain't seen nothing yet, because we have, all of this stuff is new, all of the things that we're doing in this product-led growth strategy. And then we also have a lot of work to do ahead around e-commerce and freemium and all the other things that you've heard about. So, I think we will not be able to meet our mission if we don't have all subs, all GCs, and all owners working together on the same platform. So it's just a matter of time. Also, I noticed at the show this year, we have a ton of specialty contractors here, and they're helping us get there.
Yeah, maybe the only thing I'd add is, Brad, you've been around the story for some time. I would challenge you all to go back to your customer call notes from years ago, and you probably heard this narrative that Procore is cool, but it's a GC tool. Yeah. Right? That is something that has been a reality for many years in the past, and that's where that slide where I tried to prioritize kind of the hierarchy of needs of these different stakeholders is really important, because what Will talked about is that the opportunity we see today is something unlike we've ever seen with this particular stakeholder, and it is this combination of streamlining that go-to-market, but building out the product set, the functionality, meeting that stakeholder where their need is. And probably the one other nuance I'd call out is you saw in that 100K plus customers, and $1 million plus in subs was the smallest share of that. That's because we deliberately started in that mid-market with the subcontractor, and we're seeing some really interesting traction as we've made these investments and invested in the platform and these products going up market with that audience. And we think that will also help drive that 14%.
And just to be clear, as we think about the pricing methodology around subcontractors, there's some examples there of some add-ons, some upsells. Is it going to be a little more nuanced than a fixed rate fee that is just traditionally been the pricing functionality in GCs? Are there opportunities to do smaller lands, more subscription-orientated things? Just trying to think through how you're thinking about pricing philosophy in subcontracting.
All of the above. That's where your comment of the 13,000 to 60,000, 60,000 doesn't match to the 2 million number. We talk about, like, there are so many collaborators out there, and I think the reality that we all know as folks in the world of business and operations is getting that first dollar is the hardest. And then finding the path to grow from there. And that's why we're really excited about all these different toeholds that we find ourselves in with this particular audience.
And a great mental model to think about when you think about our fintech businesses is these fintech businesses are built around some of the highest pain points the subcontractor has. And these aren't really application purchases or subscriptions. MapFi is a huge part of the challenge. So these are just new businesses that create opportunities to monetize those relationships.
Thank you.
All right, Brent.
Thanks for the Billy Idol at the break.
We were thinking of you.
Tooey, payments, I know you said it's not going to be material to numbers in 23, but where do you expect it to take off first? How do you expect the ramp to go? And can you just walk us through that lift off? And many of us cover Intuit. If you ask Intuit, what their biggest probably disappointment has been payments. It's taken forever. They've had a lot of friction. What's different in your market than maybe Intuit, again, for SMBs they face? How do you get through that friction, and can you elaborate on that? And I had a quick follow-up to Paul.
Yeah, so I think the first thing to think about is the process now is fully analog, and it's most cases. We know that there's a player in there, but and it's really slow, labor-intensive, and cumbersome. So frankly, just adding a single source of truth, a mechanism for people to have a place to go, for our GCs to go to pay their subs, is a huge relief for them. It reduces all of the headache. If you think about how payments work in construction today, on a monthly basis, people show up in the job site trailer and they drop a bunch of invoices on all the subs on the project manager's desk. That poor guy's got to key all that stuff into some sort of a spreadsheet, staple it all together, and then courier it back to the office so the office can actually put together this transaction. Then you get into lien waivers. So our processes, they're already going to be in Procore, completing these complex workflows. Lien waivers is that final last step before payments. So it's just a natural progression for them to adopt it. And we're starting with the GC to sub paying process because, as I think it was Will said, we do have, or Wyatt, we have two sides of the equation where both are benefiting. The GC benefits because you're actually improving the process of paying people, which is a huge headache. But the specialty contractor has cash flow problems. If they can take their 120-day collection down to 35 days, imagine what that would mean for them. So there's a lot of value on both sides of that equation. And then eventually, hopefully we'll be able to have owners, paying the GCs and GCs invoicing the owners. But we're starting with the GC this time.
Great. Now, Paul, in the 10Q, there was a 51% increase in sales and marketing. I think it's your fastest ramp in terms of expenditures or headcount. I believe was embedded in the filing, if I'm mistaken, let me know. But it's a big ramp. No one else in tech seems to be hiring at that rate right now. What's going on? Where are you putting these people? Can you talk through where that's going?
Yeah, I think we tried to show in the presentation kind of how we think about the distribution of that go-to-market spend. Realistically, it is going towards all of those different vectors: size, stakeholder, geo. And when we think about how we really want to staff sales and marketing, for us, that is candidly the most mathematic of the equations, right? You're able to look and understand what's the demand, what are you seeing in your market, what are you seeing in your pipeline. So what you should expect from us is that we're going to meet that demand. So we're going to be thoughtful to hiring where we see that opportunity. And where it's not there, we, as we've talked about, have an opportunity to drive that margin efficiency. So for us, it's a reflection of the macro comments you continue to hear us talk about, that our end demand remains really strong and resilient, and we need to be there to meet the customers where they are.
And just a quick add-on to that, if you think back the last several years when we were going through COVID, where we pulled back was on the sales and marketing side, but where we continued to invest was on the product side of things. And if you think about coming out of that, we made this discernible push, a deliberate push to invest in the go-to-market piece. I think what you're seeing now is a lot of the product pieces coming to fruition, and it's converging with that subsequent investment in go-to-market. We're putting those two pieces is what's converging together now, and going forward is where we're going to be able to realize both of those coming together for efficient growth.
And thank you for reading the queue. A lot of people work hard on that.
Bill, our controller somewhere in the audience, is really grateful.
All right, Jason.
Sorry, I'm a little short. I love it.
Yeah, sorry about that. It was designed for Sterling behind you. Yeah.
Sure. So Procore's got a lot of expertise in construction. It's where you started. FinTech, really interesting opportunities, but it can be its own animal. What type of, or can you speak to the internal leadership you have in place, the expertise, and attract some talent to kind of build out this knowledge?
Can I start? This is one area where I'm incredibly proud. I didn't know much about insurance 2 years ago. I know a lot about it now. I didn't know a lot about material financing. The folks that we've been able to attract are the folks that come from the industry that actually understand how this actually happens and how this works. And they also have the entrepreneurial mindset, which is they want to get out of the stodgy world of finance or insurance, and they want to go change the world. So we have these folks that have, in some cases, decades of experience in those fields that are just luminaries, that have this driving force to change the industry because they believe in our mission. And so, yeah, the quality of the talent is super high.
Yeah, and fortunately, on top of our ability to go attract talent, what we found is the industry relationships out there are really important. In this case, by industry, I mean the financial institutions, the insurance companies. These are relationships we've been building for years, and frankly, I think we have been fortunate to find that they're as excited about what we are envisioning and the opportunity we see as we are. And so, as we think about building these teams, to Tui's point, not only have we found this really great balance of folks who are specialized in construction, right? You have to understand how materials and purchasing insurance in construction works, not just insurance, but also to be able to then go out there and find partners, consultants, folks around the table who have all of these different levels of nuances. Because I think what we at Procore are really mindful of, we're students of the world around us, is that there have been a lot of names out there that have gone in kind of charged with a degree of confidence that felt a little misstated at times. And we're trying to understand much more how we bring these partners along and how we make sure that we've got the right group of people who understand all the nuances. And that's why we're also pretty thoughtful in being conservative with you all, because we know that it takes time to prove this. It takes time to see the results, to validate the relationships. And I will tell you that we're not going to be a bank, we're not going to be an insurance company anytime soon, which means you have to convince those partners. And if you can't walk the walk, talk the talk, have the people, your reinsurers are not going to put up billions of dollars to help you underwrite projects.
Okay. And then when we think about the competitive landscape, some of your other construction software management competitors aren't as vocal about the fintech opportunity. I guess what is unique about the Procore platform which could enable that strategy?
I love that you asked that question, Jason. Look, we're a platform. I don't want to speak for the others, but we're not a bunch of acquisitions that we're trying to weave together into some cogent sort of story. We were built as a platform from day one, and so all of the data is on our platform. I like to think that we have more information about where project risk lies than anybody else because of this massive amount, this corpus of data that we have. And I can't, again, speak for them, but I certainly believe when you pivot away from looking at the competitors and you look to what the industry needs, these are the things that they're asking us to do, and you can't be wrong when your customer's telling you what they need and that they're willing to pay for it.
Great, thanks.
Sure.
All right, Saket.
Okay, great. All right, thanks guys for holding this session, really helpful. I thought one of the most interesting slides that was up there earlier was the chart that you had in construction spending. I think the 3 or 4 different kind of segments of it, whether it's infrastructure, single family, multifamily, and commercial. Maybe a 2-part question on this, right? So the first one is understanding it's hard. The GC doesn't just do infrastructure, doesn't just do commercial. It's hard to break that out. Mm-hmm. But if you had to, right? Like what would
I knew you were going to go there.
I mean,
yeah.
where like what if you've ever done that exercise in a point in time, what does that sort of look like? Even anecdotally, are you more weighted to commercial? Are you more weighted to infrastructure? I think that would just be really helpful. That's the first part of the question. The second part of the question is, I think so many of us look at the growth in construction as such a big part of the formula, which it is. But the other part of the formula is the take rate. And I know we don't want to talk about take rates necessarily, but if you had to think about the growth formula here, anecdotally, how much of the growth has come from growth in construction spending versus growth in take rate?
So if I look at the latter question maybe first, the reality of it is that's where that expansion line item that we had shared, that 50%, it's coming from a healthy mixture of both. And so when you think about take rates going up, a lot of that for us is about cross-selling more and more products and getting the overall wallet share higher. Another thing, though, that we have talked about in the past with a number of you all is the way we think about releasing software is that we will go out there with a product that is what I believe I call from a Microsoft executive, a minimal lovable product. And that is to really say that this is something that solves a customer's problem and something that they can adopt today, but it's not done. It's not fully featured. And therefore, we are at a stage with a lot of our offerings where we believe they're amazing products, but the ability to actually capture more base points take rate from it is still early days just because of the amount of investment we're going to continue to make. And we have proof points with that in places like financials, quality and safety, some of these older products. And so it will really be a healthy mixture of both on the take rate side. To your former question, sorry, remind me one more time.
Let me help on this one. This is the breaking out by sector.
Yes.
I say it's incredibly difficult. So the way you would have to, well, by the way, the British Columbia specialty contractor I laid out, which is residential high-rise, commercial high-rise, and a port, right? Like, we would have to be able to take the pulse of all of our customers at any given point in time. But the problem is we'd also have to talk to the business development teams because now they may be shifting for infrastructure based on a $1.2 trillion infrastructure, and we just don't know. And so it's just really not practical to do so. And if it was, we would definitely be looking at it, but it's just not practical, I don't think.
Got it. I think it was worth a shot.
Yes. Yeah. One more thing on the take rate. Remember, mechanically, right, the more volume a customer puts on Procore, that actually brings down their take rate. They get a better price per unit, and then the more we cross-sell products, that brings the take rate back up. So historically, the company is expanded primarily through more volume when they didn't have the products they have now. So that's also why layering take rate on that chart was hard. Yeah.
Very helpful. Thanks.
Exactly.
Sterling?
Sterling Auty, Moffett-Nathanson, Silicon Valley Bank, which is a mouthful. So I have an RPO question just for Tooey.
You told me it was
In constant currency or in nominal?
Both. I'm just kidding. So one question on material financing and one follow-up on payments. On the material financing, you kind of pointed to the cash from investments section of the cash flow statement, for the impacts. But can you maybe give us a little bit more detail in terms of what is the economic structure? Is there anything that shows up on the balance sheet? Is there any loans or any capital commitment that's there? Or is it that quick that you're paying and delivering and getting paid that, it's just kind of a flow through?
So you can actually call out on the balance sheet, there is a line item for total balance outstanding. So we do show that. The reality is these tend to be about 120-day sales cycles. So they sit on the balance sheet for some period of time. But that's where we go back to that commitment we made 2 earnings calls ago, I believe, around our intent is to use this as the learning experience to make sure we fully appreciate the different ins and outs of the types of projects, the ability to enforce our liens in different ways, the economics, and how we can play with those. And so you shouldn't expect over the long run that to be your case. And you shouldn't expect us to really get to a place where it's greater than give or take $50 million, which is kind of that 10% we called out.
I think it was like low 8 figures last quarter or last week. Yeah.
That makes sense. And then, Tooey, one follow-up on payments. You kind of alluded a lot to the workflow aspect of it, but is there anything here that's going to be an actual financial transaction? Are you actually going to do the money transfer between a GC and a subcontractor? And do you have either the money transfer licenses or partnerships? So in other words, people want to know, like, whose rails will it run across?
Yeah. So if you'd asked me this question 2 years ago, we would have answered this differently. Fortunately, now we have great partners on the back end that are actually going to do all of the lifting. Our relationship with Goldman Sachs and Modern Treasury allows us to push all that off. So we're essentially just facilitating a transaction and stepping out of it at that point.
No, I mean, short of it, we're moving the money. We're just not carrying the MPL license nor the float or any of those dynamics. But what we do think is super exciting is, to Tooey's point, years ago you would have had to build all this technology. Now it just comes out of the gate, the ability to do all these unique aspects around moving money. And so it's another area where we're fortunate to be doing this in this era and being able to add a whole different degree of value than some names that did this a long time ago.
Makes sense. Thank you.
Thank you.
Yep.
Perfect. Thanks for taking mine. I just wanted to focus a little bit on the drivers of growth, specifically within existing customers. When you see going from 1-2 products, like you said, 4 or 6 as a driver, and then the other one also thinking about the usage and intensity of the usage that you're seeing within a customer. They might start on 1 project, 2 projects out of 10, let's say, and then how that moves on. How would you kind of think about the growth as a driver today at each of those segments, and what do you think how this changes in the future? Do you think they can increase the spend effectively? What does your ideal customer look like using all their projects, using Procore on all their projects versus a few?
So I think when we think about that opportunity of cross-sell, this goes back to longer it's been in market, the more likely you should expect that those are going to be the earlier drivers as we continue to grow and push some of the newer products further and further into market. But it is something that, that's why we shared that kind of breakdown of new logo versus expansion. We expect that to be reasonably consistent. And so if you think about the existing customer base, it will continue to make up a really meaningful share of that overall net new bookings trend. And that's a function of these customers keep growing. So your second comment around projects, right? In some cases, it does take multiple years to bring on their entire book of business. In some cases, you're actually winning regions, divisions, and then expanding, countries, and then expanding. All of these vectors will continue to drive that expansion metric to being a really meaningful share of the overall growth. And it's something that when we think about modeling it out, the durability, it's why we have such conviction in kind of sustainable growth for our business, because there's not one path. There's multiple different paths as to how we really continue to drive that growth. And it's why we're so excited about the position we're in today relative to what the world looked like 5-6 years ago.
I'd also add that we have a very specialized motion now that is not the standard motion of just selling to a GC. We have specialized teams that sell to owners and to specialty contractors. And the more we can know who our collaborators are and who our prospects are, the more refined the pitch can be in terms of which products they should adopt first, second, third, and fourth. And that is a motion that's maturing at this very moment. I know Joy Durling, our Chief Data Officer, is really helping us get to the point where we can really know our customer. And then once you know them and you know the progression of products that they should be taking on, you can hit them at the time of need based off of the analytics that you can look at. So again, this is a newer motion for Procore, but will be very effective.
That's interesting. Just to follow up on that point on the volume and the intensity of the usage, have you ever looked at, do you look at what's the total transacted volume for your customers versus how much it actually goes through Procore with proportion of the projects today? Is that something you look at?
Just to clarify, that's how much volume they're running in their business versus how much they have on Procore. Yes. We look at that very closely. Yeah. that directly led to that penetration slide that you'll see on how much is out there and then how much that we have. That all kind of fed into the numerator and denominator.
And then two, maybe just on international. When you look at Europe, some of the construction conglomerates that are very vertically integrated, how do you think about adjusting go-to-market approach for them, where you have Max Vogel's of the world, or someone who has everything from architect to a subcontractor within on the books?
Yeah.
Do you think you could be, I don't know, introducing flexible pricing or more enterprise type deals for those customers? Would that make sense rather than just looking at one?
Well, you're right. Especially in Europe, there are some very, very large construction companies. Like Ferrovial is a great example. But when our relationship with them is, yes, they could buy all of the kind of out-of-the-box solutions, but their fundamental problems are still the problems that Procore solves, which is bringing the project teams together and giving them a single source of truth and a collaborative platform. So in a lot of cases, they don't see us as being an or decision. They will use design software, and they'll use other forms of or available software, but they're looking at Procore as being the core foundation for communication collaboration across their organization. And what's interesting about those large multinationals is they're doing work in every corner of the world. They're doing work, and they're bringing us with them, which is great because it actually builds a lot of awareness.
Yeah, the only thing I'd add to that is it's actually not that different in the U.S. It may not be as clear, but if you go look at some of the largest general contractors in the United States, they all have self-performed divisions that go off and do a subset of the work, and in many cases they have to treat them as separate businesses because they have to separate the liability. They have to be very diligent in the handoffs. They tend to not do every trade, and that's where I think it's actually pretty similar to what we've seen in the U.S. The owner tends to be a different institution, right? Sometimes you've got a real estate developer that will try, but in general, we feel like we know this playbook and we're ready for it when we think about the international markets too.
It's what we learned about the enterprise in the U.S. to Paul's point, which is at the end of the day, it doesn't matter if you're Ferrovial or you're my friend at Gibson Crane in the back of the room right now building custom homes. Everyone's in the business of delivering projects, and every project has a certain dynamic about it that Procore can solve for, from the smallest residential build to the largest nuclear power plant retrofit. And so that's how we sell into them, which is we will help you manage your project, and that's the business that they're in.
Thank you.
Dylan?
Hey guys, thanks for taking the question and all the detail today. Maybe as we think about the stakeholder mix, how do you guys think about prioritizing investment and focus areas within those, right? So is there a greater value proposition from the owners who, again, I think Will said can obviously mandate adoption across a project, the benefits of subcontractors adding more users, flowing more data through the system that speaks to future innovation for the platform. Is there one of those kind of components that's maybe more valuable than another? And then how the penetration you guys have seen within GCs can maybe give you confidence in the ability to go ahead and capture those two because they serve as the central repository between those two?
One area that we look at very closely is what Wyatt was explaining about that two-sided equation of value. So it's less about, we're going to go heavily into specialty contractors over owners. It's more about what business process connection point is the highest value to get two stakeholders to connect. Because that connection is what actually drives more revenue for Procore. That's the primary lens I believe we look at it through.
Yeah, so I think it was Jeff who chose. We can show you a flywheel for any of these examples and any of these stakeholders. The reality of it is they're so interdependent on one another that where you bring more and more connectivity across that platform, we see value across that spectrum. And what we did have to do in previous years was go back to that chart of highest priority need and make sure we could solve those. Now it's about tying all of those things together to bring more and more compelling value to all of these different stakeholders.
And I'll point out that that's one of the reasons why I'm so incredibly excited about payments. Subcontractors actually have people that are their full-time job is to call the general contractor and try to figure out where the invoice is in the process so they can try to forecast when that revenue is going to come in the door so they can make payroll. It's a full-time job for people. And it's a black box. They don't know. But in the Procore lifecycle of all of our contract management and the invoicing, we can tell this specialty contractor where they are in the process and how soon it's going to be until they get paid. So the value that we add is just tremendous, and we're just eliminating a bunch of overhead because that connection point is really important. You can imagine if you had to pay your payroll every 2 weeks, right? But you're not going to get paid for 120 days. That you're begging somebody to tell you where that next payment's coming from, so you can make payroll, and that's what we're going to do.
Yeah, that's helpful. And then as well, maybe just quickly on the partner side too. So you talked about potential adjacent areas in insurance, material financing. As that ecosystem obviously continues to see kind of the gravitational pull of other stakeholders, how do you think about that from a monetization perspective, as well as driving incremental adoption? I think there was a quality partnership. State Farm subsidized some component of for their customers as well. How do you think about the puts and takes there?
Look, this is where I think we want to be really mindful that banks, insurance companies, they haven't survived hundreds of years and made lots of money because they're bad at business. That they're great partners to bring in that journey, and that they play a real role in that. I think when we think about like our stakeholders, it becomes really interesting because if you ask a GC, one of their biggest risks on a job is that the subcontractor disappears. And the biggest risk for a subcontractor disappearing is they mistime their cash flow. Not that they don't have a great business. Same thing when you start getting to insurance. Like there are so many customers out there. We talk about them wanting to grow, and we talk about hiring. Totally fair. What we don't talk about is what Julie mentioned earlier in the presentation. They have an amount they can bond to. They can do this amount of work. If the insurance company will not increase that bond, it does not matter if they can win bids or higher. They cannot grow their business. That constrains the owner because they can't get more competitive work out there. And so it really is this incestuous virtuous cycle where everything is interconnected and every party is dependent on one another, and risk and timing of working capital impacts all of them.
Thanks, guys.
Sure.
Garland.
Hey guys, today was really awesome, and I think showcases how you're such a different software company than other software companies. I have three questions along that line. Maybe number one, if you can help us understand how inflation in the post-COVID period is going to work its way, if at all, through the Procore P&L. I'll give you
yeah, let's go one at a time.
Sure.
Why don't you?
I'll take that. The interesting thing for Procore is we are sort of, in many ways, inflation is hedged, right? If you think about the fact that as inflation grows, that means the cost of construction goes up, and that's the construction volume metric, which is how we price our business. It also means that to some extent we are a lagging indicator of how inflation impacts our business because customers will go out there, they may sign up for, say, $50 million of construction volume because that was the expectation when they went into the year, or frankly for enterprises, over a multi-year journey, and they end up burning through that construction volume sooner because of the sheer fact that they ended up spending more money on those projects or charging more for those projects. And I think the third part of the inflation dynamic here that's even less prevalent when you look at some of the metrics we share is that because inflation went up, because the cost of construction went up, it actually means the throughput of construction, the actual number of assets that got built, went down. And the sheer fact that that means we didn't build as many hospitals, schools, multifamily complexes, means that we've only further built that backlog of the need for infrastructure and construction. And so inflation definitely makes life harder for everyone. And I don't want to tell you that there's all roses and benefits, but there's a lot to our business where we actually see the benefits of inflation later.
Yeah, it takes time to flow through, and I don't think we've seen it yet. I think it's coming.
That is very interesting and exciting. Actually, Paul teed up my next question, actually, which is, as you guys know, I'm a very simple-minded person. And so one of the things that struck me on the slides was how balanced your growth was and how robust it was, even across what is perceived to be penetrated segments. As you look out, how long can you sustain this level of growth? Because I'm just trying to bridge like the TAM, the digitization, and the fact that you have really solid growth across everything, and just get a sense of how long that can run for.
Remember the penetration piece, and we talked about triple TAM, right? That penetration piece that you saw on the screen is one part of that, one dimension or one layer of that triple TAM. So that in and of itself, in terms of where we sit today and structurally where we are today, means that there's quite a bit of runway left, both in terms of the actual growth and volume, but also even just monetizing the products that we have already today in terms of cross-sell.
Yeah, I think the thing that we are always thinking about is how do we ensure we have the right focus and the right execution. We don't really lay up at night thinking about the TAM in the sense that it is just so early days. It's sub 2% penetrated in just the markets we're in. It doesn't count all the cross-sell from a product. Doesn't talk about fintech. It doesn't talk about any new products that we see around the horizon. So I think for us, the ability to sustain is something we talked about, kind of that high 20s, low 30s growth for the foreseeable future is something we continue to feel really good about. It's just a function of all the different dimensions at play when we think about that TAM.
And then finally, I know the margin, both guide and intermediate period, has a bunch of puts and takes, right? Because you're investing in certain businesses, you have new geographies and products. But as you think about what your ultimate aspirations could look like for the non-investment piece of what the margin structure looks like, do you have any models that you gravitate towards?
Yeah, so many of you probably know this because I've talked about this in the past. When I took on the role, I went out and looked for peers that I really looked up to. And the person that was way too gracious with their time with me and continues to be way too gracious with their time is the former Viva CFO. And in a lot of ways, one of the things we spent a lot of energy, him and I, trying to make sure I understood was where do our models different? Where is it a go-to-market motion, a pricing standpoint, and where are they the same? And I think what I walked away feeling both great about is that structurally there's no reason we don't get there. What I left feeling less great about is just how amazing of a business Viva is and how much work we have to do to go catch up to that P&L.
Great, thank you.
Thank you. Is that you, Ashish?
Yep.
All right.
Hey guys, thanks so much for taking the time.
Sure.
Great event. Ashish Mandari from Ashlar Capital. I actually just wanted to ask on the partner or your partner ecosystem and potentially building that out, less so from the fintech and insurance perspective, but more as you're thinking about kind of go-to-market leverage and expanding into international, specifically where resellers have more of a role to play. I'm just curious how you think about kind of the role of resellers, consulting partners, system integrators, especially as you scale. And then I just had a couple follow-ups.
Well, when we look at a new market that we're going to go into, we look at the way that the market actually buys software. Like, for instance, in Mexico, they love to buy through their resellers. They're not comfortable in general buying from a software company. So we know based on the market conditions what the right go-to-market is, and our mantra is always like, let's make it as easy as possible for people to buy our products. So it's very intentional when we do that. But yeah, I'm sure you have.
Yeah, I mean, as we said, we'll meet the customer where they are. I think the unique thing about construction that might be a little bit different than some of these other markets that folks talk about is that when we think about partners, when we think about the folks we can go to market with, there are certainly, as Tui said, markets where the reseller has an established relationship. But I think what we found more interesting is that the playbook we've seen in the U.S. is actually something that we believe we can take internationally. And that's about these integration partners. So your ERPs and your scheduling tools, like these folks want to work with us. It's your trade associations, the union, these different parties that have tremendous value gains to their own members or to their own ecosystem by working with us, but aren't necessarily your bread and butter. We're going to take your software, we're going to implement it for you, we're going to support it for you. Like, we will absolutely do that where it makes sense, but we are always mindful that retention is the lifeblood of a SaaS company, and ensuring that you are incredibly thoughtful with the experience the customer goes through is something I don't think we'll ever be willing to give up.
That makes sense. And then just one follow-up on Procore Pay. I've been able to talk to a number of customers this week, which has been great. A lot of them have mentioned that, Texturas and GC Pay just are kind of legacy tools that don't quite work. But I guess as you kind of canvas some of your larger customers and thought about launching Procore Pay into next year, what's kind of the biggest pain points that they're dealing with as you think about that kind of displacement opportunity of market?
Well, first, I appreciate your talking to the customers, because this is what's so exciting for us, is that when we went out early on and we were doing the market research, we really thought that the payments was going to be we should start in the mid-market like we do with a lot of things. When we talked to our enterprise customers, and they found out that they could eliminate the need for those legacy solutions, they got really excited. And so their world is highly complicated, and they're moving big dollar amounts. If they get anything wrong, it's really bad. And so they've been asking, for a long time now that we come to market with something that meets their needs. So it's really exciting that the demand is high up market. You want to?
Completing the workflow, sir. Right. The reality is the names that exist out there, the ones you brought up, the other people involved in this journey, you will go and you'll upload an invoice. You will upload your compliance documents, and you will process that payment. Somebody has to build that invoice. Somebody has to actually track all of the information that goes to it, and historically they've not had a single place to have that complete visibility. And to Tui's point, we didn't build it because we thought it was a good idea. We built it because our customers were asking us, and those are the same customers that use these other offerings today.
I'll also say that these other products you're talking about, one in particular, their business model is really disliked by subcontractors, because as a subcontractor said to me yesterday, they spend tens of thousands of dollars a year just so they can get paid. And it's really, really, the brand damage that company has done to the people that get paid is pretty big.
Awesome. Thanks so much, guys.
Sure.
All right, let's take a couple online.
Yes, I'm going to hit on a couple more from the webcast. So first is on competition. Clearly, the market's super underpenetrated. We're still in the early innings, and what we've said in the past is we compete most of the time with analog solutions, pen, paper, Excel. But that also means that our software competitors have ability to grow as well. Autodesk has a lot of capital, and they're prioritizing their construction cloud. So how do you see Procore winning over competitors like Autodesk and Triple?
Well, I'll tell you one thing. This has nothing to do with Autodesk. This is to do with Procore. I think the reason we win against pen and paper or Autodesk or any one of the other competitors out there is because of how this company is structured. It's because we partner with the industry better than anyone else, and we have a higher level of trust, I believe, than anybody out there. And we understand that, and we hold that sacred at Procore. And I really do think that we win because we are the best partner. At the end of the day, an RFI is an RFI. And so what we need to do is we need to make sure that we win through that partnership. And then the beauty is once you gain that trust, they are willing to take a flyer on you and try your other products and your other services because they do trust you. So it's a virtuous circle.
Great. And Paul, maybe one for you on unit economics. How does that LTV to CAC look like across the end markets by stakeholder? So subs, owners, GCs. Is it fair to say that subs have a lower ratio given greater fragmentation in that cohort? So therefore CAC helps us understand that.
Yeah, great question. I think the thing that we have been particularly excited about as we've made these investments, as we've thought about doubling down in these different stakeholder categories, is that when you look at that LTV to CAC, when you look at those unit economics, they actually don't really vary by stakeholder. These are really compelling opportunities and high ROI sales for our different customers. I think what you'll note is similar to other companies where there's bigger differentiation is by size. And so obviously our enterprise is incredibly efficient at this point, and we've talked about with you all that the journey to bringing that 11x up higher and higher, yes, cross-sell is a big part that's understated in there, but actually the ability to do what Wyatt showed in his presentation to really drive all these different mechanisms of monetizing that long tail will, I think, take what is today still a direct sales motion with a customer success rep and a sales rep closing those SMBs to a much higher velocity motion that has real potential to drive further up that 11x that we showed in the US.
Great. And one more on that margin trajectory. What kind of gives you the conviction that we can sustain that 350 bits year over year? Where do you see that coming from?
This is a good one for Howard.
Well,
yeah, I'm about to put you on the spot.
Well, look, there's two themes that hopefully you all heard today. One is diversification, and the other one is deliberateness in terms of how we deploy our resources and our capital. Well, one of the things about the diversification across that top line is there's also diversification in terms of our ability to deploy our resources across a number of areas as well. And as we look at what happens in the demand environment, as we look at what we're doing internally in terms of how we operate, we have a lot of leverage across a lot of different areas where we can increase investment or decrease investment and manage that trajectory for that efficient growth. And to pinpoint one that's more immediate, I think the most immediate place where we can get that CAC is around that cross-sell piece. Right? We have products today. Most of our expansion is from upsell. We have products that are available today that we can monetize immediately to improve that CAC, and that's just what's most immediately in front of us. But there's a lot of leverage that we can pull.
Thanks very much.
Well said.
Chris?
Thanks for the time. You guys talked about operating margins improving by 300 basis points or so in the next couple years incrementally. I'm wondering if that was not a goal, if you were not to do that. How much faster would you guys be growing in those coming years?
I really wish you didn't ask that question with Tui right here.
I'm going to keep my mouth shut.
Look, I think it's a thought exercise that we've played through a couple of different ways, but it's hard to truly know the answer to that question. I think what we care a lot more about when we think about the equation is that LTV to CAC, the efficiency, the retention. Like, how do you make sure that you are putting $1 at a place where you will, in the arc of time, get back well more than $1? And so for us, this idea of like, well, hey, if you didn't give back that margin, couldn't you grow faster? Sure. But the reality of it is it's not an arrow of growth at all costs. It really is for us about making sure that when we think about the deploying of that capital, we've spent the most amount of investment that still yields the best overall outcome in terms of that efficiency and those economics, and that's how we get to our growth targets and our spend profiles.
The other thing that I'll add is that we talk a lot about CAC, and we showed a lot of numbers today around go-to-market. We also have internally, in terms of how we operate, areas for improvement in terms of operational efficiency across QnA and other parts of the organization as well. So I don't want to forget about that part of the equation as we go through the next several years and beyond. The other piece that is associated with that is when you look back to fiscal 20, we have gone and made sure that we reacted appropriately to make sure that our margin profile and profitability profile is appropriate for the situation that we are in. It's not that we have done it, but we will do it if we see circumstances where we need to do that.
I want to add to this. The finance team has done a great job of educating the entire populace of Procore on the value of efficient growth and the value of $1. I ran into a sales development rep manager the other day, and he said that his entire stand-up meeting that day was about driving efficiency into their little organization inside of Procore because they know that efficient growth is going to drive the stock price up and also be better for everyone. So it's the kind of the mindset of Procore is really bought into this.
I mean it earnestly and respectfully, but it's interesting to see such a well-loved product in such a large market with relatively minimal competition based on my conversations with work on the company, not grow in a more efficient way on a relative basis. Like, there aren't too many other industries. Think about things like Appfolio and the way they kind of grow more methodically. I think just understand the discipline from you guys, because what you've built is exceptional. Just weighing those two things is always on our mind, just to be candid and respectful. And then two, I'm wondering, you guys ever given like dilution targets? You don't see it too often in corporate America, but occasionally you see it here or there. You have Atlassian's a wonderful business everyone, of course, knows. I think Amazon, of course, in the past has talked about, like, we want to target 1 or 2% of dilution. It's been higher earlier in the company's life cycles. Is that something you guys think about a lot, and is it also something that you would care to share with us?
I will probably take both of those. So, look, I think when we think about, why is it that we look at a competitive landscape and an under-penetrated market, and to your kind of comment, we haven't grown more efficiently along that journey. And that is to say that if you kind of think through the presentation we just walked through, if we wanted to sit here and double down on general contractors and project management and just a handful of peripheral products, those businesses already have phenomenal unit economics. And the idea for us goes back to this mission, this vision, and our time horizon, that we are building this business for decades. We are looking at all of the different permutations of what it takes to build those network effects, to build those flywheels, and to support the industry along the way. Because one of the things you've probably heard me say before, it's one of my loved analogies, is that this is an oil tanker, it's not a speedboat. It takes a lot of work to get these folks to understand the power to change how they do business, and those were not simple or easy costs along the way. But we made these investments because we see the horizon of what is to come, and if we were purely optimizing for a 2-3 year window, you would have the economics you think you could have. On the dilution, we don't put out formal targets. What we do talk about is that we've been pretty disciplined in this in the past. We intend to stay disciplined here. This is a market where we need to be thoughtful to how we compete, but this isn't an area where we try to be outside of the norms. We actually focus pretty healthily at being in that 40 to 60% range of stock-based comp in terms of what we pay our employees. And frankly, when we think about dilution, like that is largely the biggest driver. We have done a healthy amount of M&A. We feel good about the portfolio today, and that's not something that you should expect from us. I don't want to promise you because things change, but in general on the horizon today, we're pretty thoughtful about ensuring that we keep that dilution as minimal as possible because we appreciate it's another angle by which you're able to kind of drive inefficiency into the business. And it's why I kind of deliberately made that comment when we talked about the margin trajectory, that it's not only margin, it's not only free cash flow, but it's free cash flow per share that we want to be thoughtful to as we go through the coming years.
And just to clarify, that 40 to 60 is the percentile, not the SBC. Sorry, revenue. Careful on that one. But and to reiterate that last point, we do look at per share metrics quite a bit internally. Yeah.
Last question, thinking of the time. Really exceptional businesses with these kind of long runways that you discussed. Occasionally we'll show investors just like a gut check. We're going to show you just how profitable we can be. They do that different ways. Maybe you do that today with breaking out of the geography. Obviously, I've been on many years. And occasionally, companies, on a quarterly basis, they provide you disclosures and say, hey, just wait. I know we're showing you GAAP losses or non-GAAP losses and so forth. Just look at this. And they give full detail just how profitable the underlying business really is. And then they go back to investing in the long growth line that is ahead of them. But those occasional checkups, provide investors, outsiders, passive investors who do not have the luxury of understanding the nuances that people do, of course, just how healthy the business really is. Is that something worth thinking about? Maybe you guys have today, frankly. Just love your thoughts there. That kind of communication.
Yeah. No, look, I think we are always trying to think through the best ways to educate investors, to bring them along for the journey, and to make sure that we're able to articulate why we are so excited in what we're doing and why we are so convicted in the investment we're doing. So we definitely believe that we took a big step towards that today, but it is something that as we think about the future, we will continue to try to figure out the best ways to show that information and continue to get those folks who may be more passive to truly appreciate just the magnitude of where the business can go.
Thank you.
Bill.
Just a quick question. A lot of the future opportunities around things like benchmarking and insurance really are about data.
Yep.
And it's when you talk to the customers, they think they own the data. Is that true? And secondly, are you working on pooling the data? How are you going to get them to share the data to unlock a lot of these opportunities?
Yeah, to be perfectly clear, the customers own their data. We have access to the anonymized versions of that data that we could then run analytics on and make these decisions off of. That's the distinction.
So you own anonymized data. So long as the data is anonymized, you can use it?
Yeah, as long as you can't trace it back to the source, it's ours to use.
Got it. Yeah. So things like you could create benchmarks for losses or performance for insurance purposes, and then you can compare that on a subcontractor basis.
Yeah, I mean, there's so much we can do. By the way, I keep looking at Joy Durling, our Chief Data Officer, who probably should be answering this question. But I can tell you right now what a yard of concrete costs in Miami-Dade County, like this month, because we have so much of that data in the system. It's not attributable to one customer because they're all buying concrete. But yeah, I mean, that's just one example of what we can do. But it's endless. I really do think one of the biggest assets Procore has is this data set.
Yeah. And then in terms of like sharing it for insurance, you'd have to get them to opt into it with permission. Okay.
And they are going to love it because we're going to automate the system for them, and they're going to be able to get better rates because we can show what their quality scores and their safety scores are and everything else. So they're very incentivized to want to have this access to their data.
Yeah, I think the analogy we often use is consumer credit. Think about it, at the end of the day, I can't go get a loan if I'm not willing to release that credit score, and so it's a relationship that makes sense, that exists, and so there are ways to create all the benchmarks and all of the data around the anonymized version, and then there are incentives each side of the equation has to release and share more specific, personalized data that today doesn't exist, and which means that everyone gets the lowest common denominator.
Thank you. All right, thanks, Bill. So I'm getting some very important messages that Tui has to leave to a customer session in 2 minutes, so we're going to do Cameron. No pressure, you're the last one. Okay, so let's make it a good one.
Thanks, guys. Tui and Paul, you've done a phenomenal job disclosing and just giving us a lot more information. It's super useful. It shows how you are performing with different stakeholders. what are the key problems to be solved, and it was just super informative. So thank you. You've done incredibly well.
Thanks for coming.
That was a great question.
A quick question, though. In terms of international and growing pains that you're experiencing at the moment, it would be very helpful if you could reflect back on your journey in various markets and provide some context in terms of what are the lessons learned. Make it a little more relatable for us. From outside, it's not clear. Sort of like what has been the journey like, and where you see areas for improvement.
I mean, I could start. So, as an example, one dimension is having a little more conviction in terms of directly and more forcefully executing against the operational strategy for specific markets. As an example, we talked a little bit about, Tui mentioned Mexico, or mentioned LATAM, in terms of making a call and going deeper and more aggressively in terms of the operating model from a reseller or partner standpoint. The other one that I think we have come to realize as individual markets have reached scale is that there's an amount of supporting infrastructure around those markets that we frankly hadn't really thought as diligently about. And as those markets start to get larger, making sure that we look at the holistic ecosystem inclusive of that supporting infrastructure as these markets get bigger, that we build those alongside as the top line and the opportunities continue to grow.
Yeah, I mean, I think Howard's examples are spot on, and in general, it is really, like, I know we keep the commentary somewhat high level, but it is because it's truly a reflection of the way we think about it, and that the operating model, the way we divide up roles and responsibilities, the structure that worked when you were servicing all of Europe from the United Kingdom versus now having multiple regions and then a Middle East segment that have all roll up into an EMEA region meant that the way you allocated resources, the sets of people who were dedicated to markets and their expertise of those markets, and how you share roles and responsibilities back to kind of the U.S. central side of it, all of those things are areas where we just need to iterate, right? And it's why, hopefully you appreciate our candidness in saying this is our own internal operations, and it's not product market fit, it's not strategy, it's not demand, it's not competition, it's not the thing that at least would keep me up at night in sense of it being a structural challenge that is incredibly difficult to overcome. It is a function of as we've invested, as we've grown there, we didn't pivot fast enough in certain areas, and we see that. And so, note taken that I think we can spend more time really getting deeper into some of those areas, but it is something that we remain very convicted we can solve.
Yeah, to Paul's point too, there's a market readiness spectrum that we have come to realize that you will create much more centralized command and control on a small market as you go in. Like the shared services will come a lot from headquarters before we can actually put somebody on the ground to do the marketing and the G&A functions. But as that market matures, then you want to start decentralizing control of these support functions. And so just getting that mix right is a little bit of an art as well as a science, and we're learning that as we go.
Thank you.
Thank you.
So before we break, a few other announcements. So as I said, the deck will be on the website in about 15 or so minutes. Okay, lunch is over there. The IR team will be hanging around to answer any final questions for your notes, and then